I'm Greg Hunter. Welcome to USAWatchdog.com. We're this guest haven't had on in a while. He's an expert in silver. He's an expert in precious metals. Really, you have to be in when you trade precious metals, when you give advice on precious metals, you pretty much have to be an expert in the economy, much like Bill Holter or Jim Sinclair. This guy is in the same league as those guys. We're talking about David Morgan. David Morgan, thank you for joining us today on USAWatchdog.com. Of course, you have the Morgan Report, correct?
That's correct, and Greg, thanks for having me back. I appreciate it.
It's good to be back. You wrote this book a long time ago called The Silver Manifesto. It's quite a good book. I mean, if you want everything you want to know about silver, I want to start with silver. I never in anybody's wildest dreams would they have thought that, let's see, how could they stretch this out? Maybe they can print up $21 trillion or more and hide it and funnel it into the market. Yeah, that's cray time. Nobody would ever do that. Yet, that's exactly what they did. And almost everybody who made a call based on normal metrics missed this. But yet, it sounds like the magic is running out. Tell me about silver under $15 an ounce. Are we at about a bottom?
Well, we're close enough to call it a bottom. I mean, right now, silver's spot price is pretty close to the best primary silver producers' cost of production, or all-in sustaining costs are actually higher than that in a few instances. So, you know, if you're in the silver mining business and you are an investor and you can buy it at a price that's cheaper than a major producer, you certainly could accumulate at this level and do better than a mining company. So what does that tell you? I mean, this is basically what Buffett did way back in the early 1990s when he bought 130 million ounces of silver. He was basically became actually one of the best silver miners ever. And he did it in an efficient way, buying it off the exchange and buying it for a price less than most of the miners could produce it at.
That was like $2 or $3 or $4 an ounce or something like that, wasn't it?
Well, it was under $5, basically. I mean, what his exact price is was hard to say, but well, it wasn't hard to say. It's hard to determine the exact number, but it was under $5.
Well, you're seeing silver kind of have a little heartbeat here. Gold has been catching a bit ever since, well, especially ever since they made it a tier 1 asset. The BIS finally, the clock ran out. They made it a tier 1 asset starting, I believe it's April Fool's Day 2019, which they did, years ago. And then lo and behold, they put a floor under gold. Tell me, how much more does gold have to go up for silver to get drug up with it? David, how much more does gold have to get drug up?
Well, gold needs to break the 1300 level. It just did it for the 4th time here recently within the last few days of this interview. And it got to, so far, 1325, which is a pretty good move above the 1300 level. We backed off a little bit today as we're doing the interview. I think that we're done with that level. So there's an adage in the commodities markets that resistance becomes support. I think that the 1300 level of resistance is now support. 1350, 1360 is kind of the magic level. Why? Because technically this is where the algorithms will kick in and the momentum players will start coming back in the gold market based on those technicals. And once you get into the 1375, it's a pretty open move up to probably 1450. So I think we will see the 1350 level broken to the upside this year. It may take to the 4th quarter of this year. I don't know yet. It could happen this summer. It's hard to say with this trade war situation, what's going on with interest rates, the inverted yield curve. A lot of things are playing together that are favorable to gold fundamentally.
What's the gold-silver ratio? It's at a pretty wide shot. I mean, with gold now at 1320 or 1318 or 1320, somewhere in that neighborhood. Silver is under 15. What's the ratio? What does that tell you?
It's at a 26-year high. It's at about 89 right now.
Wow.
When I started my first domains, the silverinvestor.com, the ratio is about 80 to 1. And I was making it well known to the few people that were paying attention way back at that time that silver on an inflation adjusted basis was cheaper than it ever been in all of monetary history. Although it was $5 $5 was actually less buying power than the 22 cents that silver was during the Great Depression. And so, I had a few followers, and you know what happened. I mean, silver and gold were kind of the place to be. I mean, gold had a bull market roughly from 2000 to 2011, and for 11 straight years, year over year, it was at a higher price. So, we certainly had our heartaches here in the last 7 years, the gold going down, but people got to remember from a longer term perspective that gold was really the place to be for 11 straight years. So they were coming back. I'm looking for the third major leg up in this market. I think it could be starting now, and I say could be, not would be. I'm a little gun shy after having seen a couple of false starts, but I think we're getting there now.
What does that 89 to 1 tell you? What does that mean?
Well, I mean, there's a lot of people that say there's no point in even talking about the ratio, and there's other people like me that think it's significant. And the one thing that's a fact is it tells you how cheap silver is relative to gold. I mean, that's a fact. And also, if you look at it historically, usually these are spikes. It's been as high as 100 a couple times. Usually it doesn't stay there very long. So what it tells me is if it follows past history, that we're probably about due for silver to start coming back down, the ratio to come down, meaning silver to start outperforming gold, and for the bull market to be, re-resurrected. So I look at it, even though it's 89, is somewhat of a positive sign, meaning that how bad can it get? I think this is about as bad as it can get, but the market knows anyone. We'll see.
So when you first started, you were saying, hey, silver's at 80 to 1 years ago, and you correctly called the beginning of the last bull market. And now
absolutely 555 was the breakout. Yeah, go ahead.
And so yeah. So you actually, based on the ratio, you basically were one of the few people that called the bull market in silver the last time. What, 20 years ago, 15 years ago?
Yeah, over 20, and it was the ratio is part of it, but mostly it was the technical work. I mean, silver had to break the 555 level. I said it would do it in September 2003, and it did. So gold actually started its bull market in the year 2000. Silver really, and I could, take a witness stand and verify that silver didn't really start its bull market until September 2003. And once it broke the 555 level, it quickly shot up to about 720, if my memory holds. And then it came back and actually touched the breakout point, which is 555 intraday on one day, and then when it started back up. But silver is a very volatile metal. It's a very small market and moves much more than gold or any other, than most commodities, actually. Once it moves, sometimes it can be dead to water like it was for almost 20 years when Buffett was accumulating. It was basically just hovering around the $5 up and down for quite some time. So it can do both. It can do basically nothing, or it can really, really move. It seldom does what you expect it to do.
With the ratio at 89 to 1, 89 ounces of silver to 1 ounce of gold is what you're saying, correct? It takes 89 ounces of silver to equal in value 1 ounce of gold, correct?
Yes.
And so, we had the same deal. I mean, we had,
that's right.
2015, you have now, today, we have 89, which was 80 when you called this thing before. And then we had gold in 2015, bottom out at 1045. Bull Pony called that one. And, Jim Rickard says, we've had terrible, metrics for gold, but yet it's up, 30% since 2015. And we've had terrible metrics for silver, and yet it's done nothing. Actually, it's under $15. There's about 3 years there. Has silver been the redheaded stepchild long enough? Is silver do we reached maximum capitulation? It just looks cheap to me. I mean, I'm not an expert like you, but it just looks. You're telling me, you're coming out here saying, let's see, it's 89 ounces of silver to equal 1 ounce of gold, and it's at mining cost, and that just flashes cheap. I mean, there's not a lot of risk there, is there? I mean, it's not going to go to $8.
There's very little risk if you have patience. I mean, I'm a bit gun shy because, it's been such an underperformer for every asset class. I mean, basically and I am biased, but really objectively, there is no cheaper hard asset out there than silver. I mean, it is so undervalued, but it's unwanted, it's unloved, it's misunderstood, and there's very few people that really want to get in the market at these lows. I found that true when I started the website. With silver, as I said, an inflation-adjusted low in all of recorded, modern history. I'm pounding the table saying, if you want to be a value investor like Mr. Warren Buffett, if you want something that's cheap, you want something at the bottom, here's the bottom. I was pounding the table. I was much more sure of myself at that point in time. I was correct. Looking back, and hardly anyone would do it. And I wrote an article about people don't buy bottoms. They want to, they think they should, but people buy momentum. When everybody's jumping on the boat, then they'll jump on the boat. When that train's already moving, it's starting to pick up speed, starts going pretty quick, then they want on board. But very few people have the conviction to actually have the wherewithal to buy bottom. It's very interesting about market psychology, but it's the truth.
Are you seeing a bottom then now based on, this is, I don't know if it's exactly the same, but it rhymes. It was unwanted, hated back then. It had hit a bottom. It languished for a long time. Aren't you seeing that right now? It's hated. It's hit a bottom. It's languished for a long time. It's about at mining cost. It's way underperformed gold. Aren't we seeing that again, or am I wrong?
No, you're absolutely right. I mean, from every metric you want to look at, from sentiment, psychology, all-in sustaining costs, and the amount of volume buying. In other words, the market's very quiet. There's an adage in the futures markets that never sell a quiet market. So don't sell a quiet market means you don't want to be short silver here. So, whether this is it today, tomorrow, the next day, I don't know, but we certainly are bottoming. I don't think we're going to get a new low, although I do my own work, I do my own analysis, I make my own calls. There is one guy that I do respect, and he says we have to hit a new low in silver before it will go back up. Certainly it can happen. Silver is extremely unpredictable. I mean, I've made some missed calls. I don't expect to see it make a new low, meaning it'd be in the new low, just to be crystal clear, Greg, would be a low that's lower than the 2015 low for gold, because gold and silver both put in their current lows in December of 2015. And so far, silver's is barely holding on to that level. But gold, as we both know, has moved from that, 1045 up to 1300. I think there's enough momentum in gold to bring silver up from this level. I do think the bottom is in or close to being in.
Ooh, that's good. So you think the bottom's in? And I'm writing down a little note here. That's a good one. I'm Xing that one. That's a really good bottom's in. What was the low in silver back then, and when gold was hitting 1045? What was the low in silver?
I don't have an exact number. It was 14 and change. I remember that. What the exact number is, I can't recall.
We got down to 1430 something, didn't we? I mean, did we get down to that level?
I think it was in that level, yeah. I was going to give a number, but someone will correct me because I'm 10 cents off. But no, it was in the 14s.
I mean, it's, especially with all the money printing. I mean, whoops, Shazam. We got double the national debt. We got double the debt. We got 43 trillion, not 22 trillion. I mean, could you imagine Trump's face when he says, "Oh yeah, Mr. President, yeah, we have 20 trillion. We'll work on it." No, Mr. President, we have 21 extra trillion. Excuse me, what? Excuse me, what? What are you Doomcuffs done? You idiots! I mean, why wouldn't you buy something? You're in the face of massive money printing with all the central banks. That's something that didn't happen back when you were doing your call. This was a metric, wasn't part of your call. We didn't have the same massive, unbelievable money printing with bond buying and quantitative easing and 0% interest rates. All that was not part of your call back in 2000, 99? What was that?
Correct.
That was not part of your call.
Well, I've been writing for 3 or 4 years when I made the call that the real breakout was, it was September 2003, but I've been writing on the silver market for 3 or 4 years before that point in time because it was such an opportunity to make, big capital gains, not only in the silver market itself, but in the underlying equities, which were hugely, fantastically successful in many, many cases.
Yeah. I mean, I mean, it went from $5 to 50, basically. That's a big call.
Yeah.
And but you didn't have the same kind of exponential, the things that would affect the price
Well,
exponentially to the upside. You didn't have money printing. You didn't have negative interest rates.
right.
You didn't have
Well, I'd like to
super.
comment on that, Greg, if I might,
Please do.
because what happened when, the Fed started this monetary easing called quantitative easing, and they did QE1, the market didn't really pay a lot of attention. It was kind of necessary to save the system. And then
Save the
silver
rich
broke
people.
out of a channel formation.
Stop for a minute. Stop. It was necessary to save the rich people, like Warren Buffett, that idiotic buffoon that required a government bailout to save his bacon. All this good investments, General Electric, Goldman Sachs would have gone under without the AG bailout. He loaned General Electric money at 10%. Ooh, that required a government bailout. And all of his other buffoonery investments that required taxpayer bailout. That was to save the rich people. They should have taken a hit. Anyway, I'm sorry. I digress. Go ahead.
Yeah, no, you're right. True capitalism, it's the right to succeed and the right to fail, and
Correct.
the free market should have taken those things off the map. But I digress. I'll come back. So silver moved from the 19 level up to 26, and then it was stalling out, and I was actually taking the trade off because I got in at 19. $7 move on a leverage position was quite a bit of money. And then the Fed announced QE2. I got right back in at 26 and rode it all the way up to the 50 level, called the top. So that was a huge move on an unleveraged position, let alone a leveraged position. So the reason, and I really thought this through, Greg, that we got so much momentum into the silver market was everyone that knew anything about monetary history or current inflation knew that amount of money printing, the QE2, was going to be highly inflationary. And you can do all the studies in the world, but I'll stick to my guns. There's nothing that reacts better to an inflationary market than the silver market. And it is not David Morgan saying it. Yes, those words just came out of my mouth, backed up by one of the best studies in the world, Professor Roy S. Jastrom from The Silver, the Restless Metal. You can look at that book. He did study of all the commodities, and his conclusion was that in an inflationary environment, you want to be in the silver market. So everybody, I mean, not everybody, but so many people came in the silver market with the announcement of QE2. Vast disappointment. Why? Because expectations were that money would have inflationary consequences for people on Main Street, and it did not. That money was sterilized, it went to the banks only, and it really had zero effect. I mean, zero effect into the mainstream markets. Into mom and pop, mainstream, nothing. Wall Street, yes. Banks, yes. No one else. And that was kind of the beginning of the end, meaning that then the QE3, the Operation Twist, all these other fancy things that were going on, people caught on because they're pretty smart. The market's pretty smart that this quantitative easing, this money printing, is being sterilized. It's financial engineering. It's financial suppression, really, where they're forcing interest rates down into a manner and a level that's really abnormal. It has been for a long, long time. So everything in the free market capitalistic system that exists, and I say capitalistic with quotation marks because it really isn't, but is based on interest rates. But interest rates cannot and should not be determined by an overpowering authority. It needs to be determined by the market itself. And what is the risk-reward ratio? And what is the true interest rate? But this has been taken away from the markets for quite some time. So now we have this financial repression. We have a distorted market that's so distorted that when as I think it's Craig Hentke says, there is a mother nature of financial markets, and this cannot be overruled indefinitely, although it has certainly been suppressed for quite some time. But the longer you hold that beach ball under the water, I know this is an overused analogy, the more pressure that builds in the marketplace. So if we see the market, meaning the equity market, the general stock market, start to fall off in a major correction, meaning more than 20%, I think you'll see the run to gold. And that run to gold and a confirmation by the silver market, in my analysis, would say we're on our way to the largest move up in the precious metals we've probably ever seen in my lifetime.
Wow. You think we get into a real trouble and you'll see a run into precious metals.
There'll be a run to gold because the bond market really isn't a safe haven, although it's touted to be. But how safe is something that there's $42 trillion worth of debt that cannot be repaid in any way, shape, or form? So you're either going to pay it off in dollars and just print the money up, which will have less and less value, it'll be worth less and worth less and worth less, and then it's worthless. Or you're going to have to see these bonds default where you get 60 cents on the dollar or 50 cents on the dollar or 20 cents on the dollar. That's more unlikely. The most likely case is that they'll just print their way out of it, which means that you're defaulting on the currency itself. Once that psychology hits the market, there'll be a run to gold that will be unbelievable because there's no place else to go. And this is something that people really don't understand because it happens so infrequently. It's such a non sequitur. It's one of those things that, unless you study monetary history, it's like, well, that could happen. Those David Morgans, those Bill Holters, those Jim Sinclairs, they may be right, but, that's 3 or 4 lifetimes away. That's 100 years out. Well, I'm pretty convinced it's going to be in my lifetime, and I'm not getting any younger. But I think we really have 3 to 5 years at the most before you see this blow off in the financial markets that goes back to the mother nature of finance, where these things get reset. What does that mean? It means everything gets repriced. The bond market, the equity market, the housing market, the commodities market, money itself, interest rates, everything that has to do with the way we operate in the financial sector now gets repriced. On the other side, you've got the powers that want to be running everything, thinking they're totally in control. And for the large part, they have been. I'm not trying to discount it. And they want to cast a society. They want everybody basically know your customer. Everything that you think, do, and say is on that chip today or on that smartphone or on that debit card or whatever. And so there's really these two forces going back and forth. And money really, is extremely important for the way people think. I mean, the one thing about the work that I do is that money transcends almost everything. I mean, it really, in some cases, transcends, religion and sexual orientation. Everybody thinks about their money. And when they really start fearing that its value is going to be less tomorrow than it is today, such as i.e. Venezuela or Argentina or Iran or any of these other places that are familiar with that and living it today, are going to take actions. What we haven't seen is that happen in the U.S. dollar. The dollar, in my view, will be the last to fall. But once, as I said earlier, the psychology changes, where I rather own something of tangible value, like a jar of peanut butter, as a corny example, rather than getting my paycheck next week because I don't know what it's going to buy, you've lost it. And this is what they fear. The banking establishment, fears the most. This is something that once that happens, they really can't control it.
Glad you brought that up, because even with all the money printing, I pulled this off of JS Mindset. I think Bill Holter had some comment like, yeah, nothing to see here, even though the charts come from the Fed. And his point is simply, these are Fed charts, right? And just note that the arrows that are, everything going up is bad, everything going down is bad. I mean, here you have, hold on, let me put my glasses on. Just give you a quick, okay, so here we go. Student loans going up, food stamps going up, federal debt going up. What's this? Money printing, that's here, going up. Health insurance costs, thank you, Obamacare. And then stuff going down is labor force participation rate, that's bad. You have what is this? Share of the, workers' share of the economy, family insurance. Median family income, home ownership down. I mean, everything that is bad is going up, and everything that is bad is going down. And this is why you're seeing a call by Donald Trump, which they must have seen this a while ago. Remember when they came out and all of a sudden, boom, we need a half-point rate cut. Wow, and then we did a 1%. We did a 1% rate cut, 100 basis point, and then we have now one of the big banks saying we need a 75-point rate cut. Well, what's going to happen to the U.S. dollar when they start having these big rate cuts, David Morgan? What's going to happen to the U.S. dollar?
Well, the be sold off, basically. I mean, people got to remember that interest rates are not only a function of, return or yield, but they're also a function of risk. And the market is mispriced, not only the yield, but the risk. I mean, there's a great risk in holding a dollar because it is becoming worth less and less. Fortunately for the U.S., we are the strongest currency out there for a variety of reasons, but primarily since we are the reserve currency, so many banks have to hold it. Plus, many of the major settlements are in U.S. dollars only. That's changed somewhat with the BRICS and the Asia Infrastructure Investment Bank and et cetera. But nonetheless, the dollar will probably be the last standing. And I actually think when this run to gold happens, there'll be a run to the dollar first. Because if you want out of the stock market and you want out of the bond market, there's about 99.8% of the population that is not familiar with gold or its history. So that means the vast, vast majority of investors are not familiar with gold whatsoever. And some that are familiar with gold at a cursory level poo-poo it. It's just a mineral. It's a pet rock. I mean, you've seen these type of articles in the mainstream press like the Wall Street Journal. So there's kind of this bias against gold for the mainstream financial press. So what will happen is safety means liquidity. It means dollars. So there'll be a run to the dollar, and the dollar will become stronger, in my view, and this is a studied view.
Wow.
And at the same time, gold will be going up because the people that understand finance, understand monetary history, and understand what's really taking place won't want to be in the dollar, because what happens is as everyone's running the dollar and it gets this temporary reprieve, and it may be a week, a month, it may be months, probably will be 3 months, 4 months, 5 months, I don't know, the market does. But eventually it'll be, wait a minute, these dollars are losing so much value that I've got to find an alternative. And that's where you find people buying, another car or another house perhaps, or that jar of peanut butter I referred to earlier, or anything. Well, a lot of the more sophisticated money will run to gold. And the financial press pretty much has to report the price of gold. They might not report, have someone like me on there explaining why you don't want to be in the bond market, but they will have to report the price of gold. People will hear that, especially the internet and social media and everything that's going on in our world today. And once that run to gold starts, it will, as I said earlier, be, I think, the biggest rush into that commodity that we've probably ever seen. And the reason being is there's really no other alternative. Yes, the cryptos will take a bid, and I don't want any of my crypto friends out there. I'm neutral to somewhat negative on them, but nonetheless, there will be a rush into them, especially the younger people, the millennials. So it'll be gold and cryptos, but primarily gold, in my view.
Druckenmiller, the big investor, Druckenmiller's, this is reported on Zero Hedge, that he's selling it all. Sell the house, sell the car, sell the kids, and he's going to go to the bond market. He expects interest rates to go to zero. Isn't that kind of negative? What's going to happen when all these big-time investors who know this is a scam, they're not going to, they're going to cut rates. I'm going to pile back into stocks. They know this whole thing's a scam. They're not stupid. They know it's manipulated. They know about the missing money. You don't invest billions of dollars and not know this thing's a rigged scam, that this is not a real market. They know it's not. But people like Druckenmiller is the first to say, boom, I'm out. I'm not going to stocks. I'm not going to go back in for another 2 or 3%. He's out. He's gone. Yep. He's in the bond market. And then he's probably thinking about, wow, what do I do now?
Well, that's the right place to be if interest rates go lower. It looks like they will. I mean, when interest rates are lowered, then bond prices go higher. So if you're in bonds and interest rates fall back down, then you're making money. And that's a smart move on I would say, on a temporary basis. Temporary, not, 2 days, but probably, who knows, 6 months, a year and a half, I don't know. Probably a year and a half would be my stab at a guess. But eventually, the reality is what I've been saying all along this interview, is that the realization of those bonds cannot, will not, never will be paid off in value. They may be paid off in face value on a prima facie manner, meaning that you'll get your dollars, but those dollars won't buy much.
Yeah,
so this is a reality, and Druckenmiller knows that better than I know that. But that doesn't mean that he's not willing to take the risk to see interest rates come down. See, everyone wants the system to hold together. I want the system to hold together. I don't think anyone is rooting for this thing to take place. But it is. It's going to happen. It always has and it always will, because you cannot live this lie. You cannot print yourself wealthy. You cannot do it. And this is what's been tried to be accomplished. But the reality is, it's a 2008 financial crisis, which is how the mainstream refers to it, and it's an apt description, is that we've printed our way, but we haven't printed our way out of it. And lowering interest rates by even 75 basis points when they're this low already will help bring the bond market up, and people like Druckenmiller will be able to capitalize on that. But it won't solve the problem, and the problem remains. And the problem, I think, doesn't have much longer to be resolved by the forces, as I keep referring to, of the actual market itself. The market's bigger than even the banking system. Once you get the psychology to change and somebody jumps out, let's say a Japanese bond trader decides to off a number of treasuries at the same time China starts dumping theirs, all of a sudden Russia sees that and they get rid of the last little vestige of U.S. bonds that they hold. All of a sudden there's an exit going, and what happens then? When there's that much bond selling, somebody's got to buy it, which would be the Fed. But it'll probably mess with the interest rates. And interest rates started going up because the market is determining what to do with the interest rates, not the powers that be. So there's a lot going on that people really need to pay attention to. I've said for years that the bond market is the place to look, and it's a place to watch, and it's probably going to be the one place that tips its hand. And yet we're looking at the can going down the road. Go ahead, get in the bond market, watch these interest rates come down, but it's not going to do any good as far as healing the system. The system is broken. It's been broken for a long time, and the only way to fix it is the commonly used reset, where the market determines the repricing of every asset out there. And believe me, if bonds are priced correctly, they wouldn't be priced where they are right now. You'd have much higher interest rates because they're so risky.
Oh, yeah, that's right. Much higher risk interest rates. David Morgan, you tell us about the Morgan Report. You have the Morgan Report. You have subscribers. This was great, man. This was, listen, you're not saying the market's going to crash now. You said 3 to 5 years. I have some people think 3 to 5 months. I think you're seeing it right now. Some people say you're seeing it right now.
Well, I think the market's starting on the way down. I think it'll be this year. But as far as what I was trying to hopefully be very clear here, I don't think we are going to go more than 3 to 5 years before we have this reset that everyone refers to. In other words, I can't see, but I've been wrong. No, I didn't think it'd go this far, and you've said that with many of your guests.
21 printed trillion dollars.
We have, but I still stand my ground not to be stubborn. Just looking at what's going on with the trade wars. Everything's taking place now, Greg, that's history's repeating. Meaning that in the 30s you had the Smoot-Hartley Act, and now we've got this Trump trade war thing, this protectionism, this nationalism, this we first, and all this stuff that took place in the 30s. We're seeing it repeat right now. So I think we're headed off in that direction. I think the tea leaves are pretty easy to read here. So having said that, I don't think not only is the stock market probably going to be lower at the end of this year than it is currently, and it's starting this year, I believe that as well. But what I'm trying to convey is that this massive change where everybody has to see it is probably, as far as maybe 3, perhaps even 5 years out. Although if I'm going to make a stab at it, I think you'll see the precious metals peak probably 2022, 2023, which is 4 years from now, 3 or 4 years from now.
Dollar cost average in silver at or near mining cost, and you study this profoundly.
Oh, yeah.
Profusely. You study it a lot. I don't know how anybody could get hurt just, at this point, dollar cost averaging some silver.
Well, you never get hurt if you follow what I said in the 10 rules of silver investing. I mean, the 10th rule is, no matter how good an investment is, don't take too much of it. And so I'd always recommended about a 10% holding. I've gone as high as 20. But if you're at 10%, what do you do with the other 90% of your money? Are you in the energy sector? Are you in real estate? Are you in, foreign equities? Are you in the currency market? I mean, there's a lot of other places to put your money. But people that hear the story of gold and silver realize that fiats always fail. They overload because they're unsophisticated. They don't realize, and I just admitted that myself, is that these systems could go much further than you might anticipate. I mean, a lot of us anticipated failure in the early 2000s. I mean, in my library, This part of my library behind me, I mean, I got about, I don't know, 4 times that amount of books in the basement. There's a book called Bankruptcy 1999. And I mean, that author makes a great case for why we won't ever make it into 2010. Well, here we are 20 years later, and we're still muddling along. Yes, we did have the 2008 crisis, but so far, we've been able to pretend that things are okay when they're really not.
And then we have inflation. I mean, John Williams says it's ticking around
Real inflation.
10%.
That's where I think you're going to see it this year, Greg. I'm glad you leave me in one more opening, and I know you don't want to wrap it up.
Captain Austin Fitz also.
We really want to pay attention to the agriculture markets, and you do that from your weekly wrap-ups.
Record level flooding.
You have really got to pay attention to what's going on in the food sector, because this is the one place that the Fed can't control it, and that's the most sensitive to the average American. So when they start having to pay more and more and more for food, they don't give a darn what the Fed says their inflation rate is. They know food costs them more, and I think that's going to take place this year. So that's another reason I think we got to be more alert to what's really happening.
The USDA has already predicted lower yields, higher prices. Lower yields, higher prices. I mean, corn's getting wiped out. Corn is getting. A lot of farmers have missed their deadline to plant at one of the big key dates was the 31st of May. If you don't have corn in, you can't get insurance. I think the next date for beans is the 25th. There are going to be millions of acres won't be dry enough to plant anything this year along Mississippi, the Missouri, the tributaries, the Ohio. Millions of acres will likely not get planted this year. Millions. So,
exactly.
So the inflation question is real. Captain Austin Fitz also brought up that inflation is 8 to 12%, depending 14%, something like that. So the inflation thing is going to be what breaks the bank. We're trying to get to 2% inflation. People say what? 2%? What? I got more than 2% inflation in my house, right? Yeah. So and then we have also the war card that could get flipped over in Asia or in the Middle East. I mean, nobody wants war, but that's a card that's a possible play, right?
Right.
All right, David Morgan, your Morgan Report. How do you people find you?
Yeah, just go to themorganreport.com to get our free email list. I'm going to make a special section. I do a weekly update. I call it the Weekly Perspective. It's much shorter than yours. I try to keep it around 10, 15 minutes at the most. So you want to be on that because I give the top tier financial news and always end with some comment about the precious metals. But above and beyond that, for your listeners, it'll be for everybody that's already on the list. So I'm going to talk about, a couple of plans to be a silver stacker, gold stacker, platinum, palladium, if that's your choice, and how to make money doing that. I'm going to talk about how to beat the bankers, how you can use the options market. This is for sophisticated investors, but I'm going to put it out for everybody's benefit for those that choose to do it, or at least see the free webinar on how to do it. And you can play what they do. You play this game of as the market moves, you make a move to basically get a monthly income. I'm also going to put out a couple things on the new report that I'm doing, Coming Energy Boom, and a few other goodies. So get on the free list. Yes, we do let some coin dealers rent our list. I vet them. I know them well. Like you do yourself, Greg, I only do the best of the best because I know and trust these people. I don't want anyone to get burned.
Well, I only have one.
At this a long time. I know who's who and what's what. So if you get an ad from the Morgan Report free list and you don't want it, just ignore it. But at least get the interviews that I do every week and the weekly perspective because it's well worth it and the price is right. It's free.
Good job. Okay, themorganreport.com is the website, correct? And then you'll send me the sign-up page. I'll put a link in after the interview. David Morgan, thanks for joining us today. It was great. I was excited. I hadn't had you on maybe a year. I was excited to have you on. I mean, pre-interview, I was like, ooh, David Morgan's on. Anyway, David, thank you for joining us today on USAWatchdog.com. Appreciate it.
Greg, it's always a pleasure. Thank you.